Investing in apartment buildings can be a path to financial freedom, but one wrong move can lead to devastating losses. Many investors lie awake at night fearing costly mistakes that could turn their dream into an absolute financial nightmare. In this video, we're breaking down the biggest apartment building investing mistakes and sharing how you can avoid them to protect your investment and achieve success. My name is Stacy. Welcome to RMFI Academy, where we empower working professionals to achieve financial autonomy through multifamily real estate investing. All right, so let's talk about one of the mistakes you absolutely want to avoid, which is not doing proper due diligence. So some of the common mistakes that new investors make is skipping inspections or ignoring how to research a market or not verifying financial statements. So let's talk about some of those things. Look, your building inspection is hands down one of the most important things for you to do when you are having a building under contract that you're planning on closing on. Why? Because how else are you going to know what's wrong with it? And the last thing you want to do is close on a property with a whole bunch of stuff wrong and not even realize it. Because one, maybe you could have backed out of the deal and saved yourself all that headache. Or two, maybe it's not that bad, but you could have got a price reduction or a credit to help you with some of those things. So skipping your building inspection is something you never want to do. Ask me how I know. The other thing that you want to make sure that you're investing in a market that makes sense, that's on the proper trajectory of growth. So a really common mistake, if you don't know any better, would just be like, I'm just going to invest at home because, well, it's at home, or I'm going to invest in that market because I heard that market's really hot. Look, when you're investing in cash flow properties, there is a very specific set of things you need to look at to make sure that that market is going to make sense, not just for today and not just for cash flow, but also for the future. All right, one mistake that's kind of common to make is not going deep enough into the financials, is taking the information that the seller provides you and just taking it at face value. You never know who's providing what and what their motivation is. It is up to you. You are the CEO of your company. It's up to you to verify that what you're buying is what you think you're buying. So let me give you an example. One of the things we do during due diligence is we verify leases. So when you get a set of financials from the seller and it says rental income is this much per year, you need to be able to go back to some kind of source document and prove that the rental income is in fact that. So you're looking at leases to make sure, how much does the rent say? How does that compare to the rent roll? How does the rent roll up into the financial statements? So you want to make sure that you're verifying financials. Otherwise, you might end up buying something that doesn't perform the way you thought, which unfortunately, once you've bought it, now it's too late. But you want to make sure that when you're putting money down on a property, that the cash on cash return that you projected, that it's realistic. And the only way to know that for sure is to actually validate and verify the information on the financial statements that you're given. All right, so how do we avoid making some of these mistakes? Well, for one, when you're doing due diligence, you want to make sure you have a comprehensive A to Z due diligence checklist. I'm telling you what, when you get to the point where you have a property under contract, it feels like it is chaos central. Then the clock is just ticking. You want to make sure that you have an A to Z list so that as you're going through and doing different things, you can check them off. Here's reality. You might say, okay, I have these 17 things on my list of due diligence, and you might ask the seller, hey, I need these 3 things. And now you're waiting for them, and maybe it takes them 3 or 4 days. In the meantime, you could be doing other things. But the only way for you to keep track of all of that is to have an organized, detailed list so that you can make sure you don't miss anything. Another thing you can do to avoid costly mistakes is making sure that you're hiring the right inspector. So for example, if you're buying a 20-unit apartment building and you're hiring ABC Home Inspection and they're usually just inspecting single family homes, that's not the right level of inspector. You need to hire someone who has experience with buildings that are similar to the size of what you're buying. So you want to ask them questions like, what kind of properties have you inspected? How long have you been doing this? What is your background prior to being an inspector? Right? And that will give you an idea is if that person is actually qualified to be inspecting your building and giving you the information that you need to make an informed decision. All right, another common mistake is underestimating renovation costs. So painful. So when you are going to do a project and renovation is any part of it, if you're just kind of pie in the sky, giving estimates, yeah, it should be about this amount, you're making a huge mistake. When you're going to be renovating, you need to get an individual rehab quote for the building and for every unit that you're going to be renovating. So what does that mean? And what's the big deal if you don't do it right? Well, frankly, if you underestimate what your rehab costs are going to be, then chances are you didn't get enough capital to do the deal. So now what are you going to do when you still have $80,000 of renovations, but you didn't plan for it? You're going to have to go back to your investors, and that lowers everybody's cash on cash return. It's a no-go, not something you ever want to do. So make sure that you're not just getting a quote on that. You always want to get at least 3 quotes, because sometimes someone will give you a quote just because they want your business. And then when they get in there, they're like, oh, well, actually it's X, Y, and Z. All right, so that's one thing you can do, get multiple quotes. The other thing is you need to make sure you always have a contingency. So if you know that your renovation costs are going to be $200,000, make sure that you have another $25,000, $30,000 just budgeted for buffer for just in case. Because guess what? There's going to be a just in case. There's going to be some random thing that comes up that you couldn't have predicted, didn't expect. Maybe it's behind the walls. But when you go in and you create that buffer and you include it, you're not stressing out. You're not staying awake at night like, oh my gosh, what if anything goes over budget? You've already planned for a certain amount. And heck, if you don't need it, great. That's just extra money for you. But if you do need it, you're not stressing out about how you can make this work. All right, another big mistake that can totally keep you up at night is basically mismanaging the property management. And that can look like a lot of different things. And it doesn't necessarily mean that you're not doing what you need to do, but like, what if you selected the wrong property manager? Well, how do you know what the right property manager is? Well, one of the most basic things that will help you narrow the field is making sure, similar with the inspector, making sure that you're hiring a property management company that is very familiar with managing the type of property you're buying. So if you're buying a 15-unit apartment building, it's probably not going to make sense to hire a property manager that focuses almost all of their time and attention on 100+ unit apartment buildings. It's a different level of business that requires different attention, different expenses, different systems, different everything. Same thing with, you don't want to hire someone that only manages single family homes, because they have no idea what it takes to successfully operate a 15-unit apartment building. Another common mistake is basically thinking, they got it. They're the ones property managing it. I'm good. I'm just not going to pay attention anymore. It's absolutely one of the biggest mistakes you can make when it comes to managing your property managers. Like, your property manager, they're the front line with your residents. When you're doing a value add project, they're the ones that are actually executing the plan, but with your guidance and with your direction. So the one thing that you never want to do is just be like, okay, you got it, and be totally hands off. This doesn't mean you need to be there, and it doesn't mean you need to go there. It doesn't even need to mean that you spend a ton of time. But when you have your business plan that was created for that property, along with your property manager, because you're usually doing this, together, making sure every week that they are on track, how things are going. And then if something's not going right, making sure that you immediately bring it up. Like, hey, what's going on with occupancy? I see we've dropped down to 87%. What's going on with the marketing? And just asking questions. That's going to set you up for success. So if you're not doing that, what you're going to find is that your building just slowly starts to decline. And if your net operating income is declining, guess what's also declining? Your value. Now, some people say, well, I'm going to hold on to it forever, so what difference does it make? Well, first of all, you're probably not going to hold on to it forever. But even if you did, there's going to come a point in time where your property value is going to matter if you want to refinance to get either a better rate, or maybe you want to refinance because you've increased the value and you want to pull cash out and go buy another property. So either way, the value of your property is extremely important, because that allows you to have a variety of exit strategies, whether it's exiting to sell, 1031 exchange and move into the next bigger one, or if it's to refinance to get a better rate, or refinance to pull cash out and buy another property. All right, so you want to make sure that you are always staying on top of your property managers and managing them. One of the things that can really become a problem is if there is not a good tenant screening process in place, and that can cause a lot of headaches. Now, I'm never going to suggest that you be the one screening the tenants, right? That's not why we got into this business. However, when you are interviewing property managers, one of the key things you need to ask them is, what is your screening process? And you want to make sure that it is thorough, because the last thing you want is somebody living in your property that ends up being a bad tenant, and now you got to get them out. Because if you have to evict them, sometimes that can create months worth of vacancy expense. And vacancy expense hits your net operating income. And that lower net operating income hits your value in a negative way. So you have to make sure that the screening process for the tenants that the property manager has in place is solid. And part of the way you're going to know that is by interviewing multiple different management companies and asking them, what is your tenant screening process? because you're going to find that there's some that they are so laser focused on making sure that the resident is solid that it'll be clear when you're dealing with someone that's not, like, what the difference is. All right, before we get too much further, let me just tell you, look, we have 8 masterclasses that we've done, and we made them free so that you can go and learn as much as you possibly can about investing in apartments and getting started. So if you go to warriorsofwealth.com, put in your information, the next page is going to be 8 fantastic masterclasses where I go A to Z into detail so that you can actually get started. And of course, put the link in the description so it's there for you, warriorsofwealth.com. All right, one of the other mistakes that it's really going to stab you in the stomach if you don't pay attention to it is doing inaccurate financial projections. So when you're doing financial projections, when you're looking at a deal and you're analyzing it in the beginning, that is something that we call underwriting. So when you are underwriting a deal, you are trying to find out what are the actual revenues and what are the actual expenses. Not only that is what are the opportunity that you have. So maybe the rents are a little bit low and you have the opportunity to increase them over time. Maybe the expenses are a little high and you have the opportunity to decrease them over time. But one of the big mistakes that a new investor can make is just trusting that the information given to you by the seller is accurate. But there's certain things that are just going to be different depending on who's buying it and at what price and when. Like your property taxes, they're going to be different than they are for the seller. So if you ignore that and you don't know to look into that, that can bite you big time. That's going to eat into your cash flow and it's going to really eat into the value of the property. Insurance is another big one. And look, if you get a set of financials and you say, okay, the revenue is this amount, cool, that works for me. But if you don't go back and actually validate and verify that information, you could be missing something big. So how do we do that? So we will pull up the actual leases. We will compare the leases to the rent roll. What the heck is a rent roll? A rent roll is a list of all of the different tenants that are in the building and what is the monthly rent that they paid. There's usually other information in there like when did they move in? When is their lease date end? What's their security deposit? Stuff like that. So you want to make sure that that rent roll that should, in theory, tie to the amount of revenue that they're showing the financials, that there's some kind of physical document that the tenant has signed that backs up the information that is on that rent roll. Another thing about the rent roll that can kind of give you an indication that something's not right. Let's say that you're looking to buy the building now and you're looking at the rent roll and you see, this is interesting. Let's say it's a 10 unit. 7 of the 10 tenants just moved in within the last month. Interesting. Now, could that be legit? Absolutely. What if the seller just renovated the units and they filled them and now they're selling it right away? That's possible. Not likely, but it's possible. But if I saw a whole bunch of tenants that just moved in, here would be what I would be absolutely concerned about. I'm going to give you a heads up so you can look into this yourself in case you see this in the future. If a seller is just trying to move a building quickly, like who are they selling it to? Selling it to an investor. Well, what does an investor want to see? That the building is full, that there's rents coming in, that there's tenants. So if they're selling to an inexperienced and uneducated investor, that investor might just say, okay, cool, the building is full. But when you're knowledgeable, when you're experienced, when you're educated, you're going to look at when did everybody move in? For example, if I saw 7 out of 10 people just moved in, my immediate thought is they're just trying to fill the building with bodies so that they can sell it. But what do I want? What do you want? We want those bodies to be qualified tenants, good quality tenants who we know are going to pay month over month over month. So the very first thing I would do if I saw something like that is I would ask for, let me see the applications and let me see this screening that went on for those tenants, because chances are they just filled the building. And that is the last thing you want to end up taking over. Because now not only do you have tenants not paying, potentially, now you're gonna have to go through eviction. You're gonna have lots of vacancy and now you're gonna be covering that mortgage payment out of your savings account. You don't want that. All right, so along the lines of inaccurate financial projections would be on the expense side, like underestimating expenses. So some of the big ones that you could underestimate when it comes to the expense side are frankly property taxes and insurance. They're the ones that knock out new investors the absolute most. So if you underestimate what the property taxes are going to be for you, if you underestimate what the insurance is going to be for you, and you're just relying on what it is for the seller, you're going to get creamed and you don't want to do that. So make sure you're verifying that information. All right, another mistake when it comes to projecting out financials is not paying attention to what's going on in the market. We talked about when you're actually researching markets that you want to look for places that have population growth and job growth that is at least steady, if not increasing. So one of the biggest mistakes you can make is if you don't realize that the population is on a decline and you're overestimating your revenue because you're overestimating the supply and demand in the market, that's going to end up hurting you later. So you really want to make sure that you're staying on top of market trends and, is the market softening? Because sometimes, real estate, it's like a roller coaster, it goes up and down, up and down. It's cyclical. It's not a bad thing, but you need to know where you're at in the market cycle so that you aren't thinking, oh, cool, I'm taking over this building. The market or the rents are under market. We're just going to increase them. We're going to increase them a couple times a year until we get everything up. But if the market rental is soft, or let's say they just brought on, 5 new apartment buildings in the last 6 months, so now there's a lot more supply, you might be overestimating the amount of rental increase you can get. So it's important to be conservative as you're doing all of your numbers, your rental increases, your expenses, so that, if you hit it, awesome. And if you do better than that, even more awesome. But if you are being too aggressive with your assumptions, unfortunately, the market doesn't tend to reward that kind of behavior, and you're going to end up having a building that pays you less than you thought. And guess what? That's going to keep you up at night. All right, let's talk about the one that's been personally the most painful, but the best lesson for me was not being over leveraged. What does that mean? Well, I don't know if you remember back in 2008, there was this whole housing crisis. Well, what was happening right before that, because I was well into my investing. I was 5 years in at that point. And now you could get 90% loans on 2 to 4 unit properties, and you could get much higher leverage on property, which was awesome in my mind because that means you have to put less down. So here's the challenge. Being over leveraged means you're really taking on more of a loan than you should based on the income of the property. So nowadays, banks are a lot more conservative, so it's really unlikely you can end up in this situation because they don't want to end up in this situation. But when you have too much leverage on a property, you just don't have any kind of wiggle room. So if there's any kind of change in the economy, COVID, for example, now that was probably a one-off, but that, or there's all of a sudden a huge employer that goes out of business in the market. If there's anything that happens and you need to be able to kind of hunker down or pivot, if you're leveraged really high and your loan is really high, your debt service is really high, man, you're kind of stuck. And that could be a bad position to be in when you need to be able to be flexible. And look, if you're in this business for apartments, you're in it for the long term, which means you want to be leveraged at a point where the cash on cash still makes sense, but you have the ability to ebb and flow when financial times are tough. Because sometimes, it's like you can't lose. There's so much financial prosperity. But then there's other times where you can lose if you don't have the ability to pivot. So I learned that lesson in 2008. Is probably the biggest lesson I learned is don't be over leveraged. Even if it means you can put down less money, it would be better for you to have fewer properties with lower leverage than to be at a point where you could really lose everything because you don't have the wiggle room you need to adjust if the market requires it. All right, another big mistake that, frankly, the last few years we've seen a lot of people make. And there's a lot of people in pain because of it. And I would love for you not to be one of them. When you're looking at buying a property and you're going to go get financing, you will usually have the option of getting fixed rate debt or variable rate debt, right? And in other videos, we go into a lot more detail on what those are. But at a high level, fixed rate debt is, you're paying the same amount every month. It's a set interest rate. It doesn't change based on anything. Variable rate debt is usually lower, which makes it attractive, you think. But the lower rate, which means it costs less, which means your cash flow is going to be higher. So that's really appealing. The challenge is if you happen to time the market incorrectly, like many people have recently, you could find yourself in a situation where you got in at a really low rate, but when rates start going up and up and up and up, that can actually flip your property from being cash flow positive to cash flow negative. And unfortunately, there's a lot of investors that have really big properties that are facing that exact thing right now. The thing is, for many years, there's certain markets that, frankly, they just don't really make sense from a cash flow perspective, but they're hot markets where the only way you're going to get that property under contract is if you offer like some crazy high amount. But if you offer some crazy high amount, well, the numbers don't work unless you get variable rate financing, so the interest rate is really low. So as long as nothing changes and the economy stays the same and the Fed doesn't increase the interest rates, you're fine. But what have we seen over the last few years? That is not reality. And the fact of the matter is, we've been doing real estate for over 20 years. So we've seen market cycles. That is not new to us. And the one thing I know is when things have been good for a long period of time, they are not going to stay good. So when interest rates are low for a long period of time, it's going to switch. It always does. All you have to do is look at history to see that there are trends and cycles that happen over and over and over. So I guess one of the benefits of being in this world for a long time is you learn those lessons early on so that you don't have to keep making those over and over. Well, if you're getting started right now, you don't have the wisdom of having gone through those things. So I'd love to just share the wisdom with you so that you don't have to go through the pain to get the lesson. So when you're in a period of where interest rates are really, really high, like they're fairly high at the time of this recording, if we start seeing them starting to go down, that might be a safer time to start doing some variable rate interest. Although right now I'm like, I don't know if I'm doing anything but fixed rate interest. But I know for an absolute fact, when we started our academy, like from day one, to me, it had been too long. Things have been too good for too long as far as the interest rates. And I told our students, look, I know it's tempting and I know that you can get it for cheaper, but I'm telling you, the interest rates are not gonna hold. This has been way too long of being this good. They're gonna go up. So don't fall into that trap. So all of our students, when they were looking at deals, they got into fixed rate debt, even though it was more expensive. And even though everybody else out there was like, you're crazy, why would you do fixed rate debt? And they're like, oh, my coach told me we should. And you know what? Who's not stressed out right now? Our students. Why? Because they didn't take variable rate debt. And unfortunately, when you do that, when you're getting variable rate debt, and some of this might make sense for you as you're seeing what's going on in the market and you don't exactly understand why. When people haven't been doing it for very long and they think, oh, I can get this property I can pay this much because I can get this cheap debt. And they don't recognize that what's going to happen when the interest rates go up. So they buy a rate cap thinking, okay, the rate cap will, that'll mitigate my risk. But even when the rate cap goes up to the cap, it's still flipped the property upside down cash flow wise. So you want to be extremely, extremely diligent when it comes to looking what's going on in the market and really not lining yourself up where you have to be absolutely dead on accurate with the market timing in order to succeed. I'd far rather you be a little bit more conservative and think on the long term than, what can I do to get that property in this hot market under contract? Because hot markets, they might be hot, they might be sexy. The reality is, what are you doing this for? If you're doing it for cash flow, if you're doing it for long-term generational wealth building, then you want to buy in areas that maybe they're not hot, but they're going to be consistent and produce for you over and over and over. And just want to make sure that you're lining up your financing to go along with what your plans are for long-term success. Now that you know the biggest apartment building investing mistakes, let's help you understand how to find the right property, how to manage it, and what major pitfalls to avoid. I made a whole series of videos that go deeper into each one of these topics. So click the video that's on your screen right now, and I'll see you there.